Now, let us move to the next important element of an international sales contract, the pricing currency. In an international sales contract, the payment currency can be the currency of the buyer country, the seller country, the seller country, or a third country. The choice of currency is not random but depends on various economic and commercial factors. Firstly, the parties usually consider the strength and purchasing power of the currency, preferring strong, stable, and widely accepted currencies in international payments to minimize exchange rate risk. In addition, the trade practice of the industry has a significant influence, as many commodities in the international market are traditionally traded in certain currencies. The choice of currency also reflects the intentions and bargaining positions of the parties. The party with stronger negotiating power often has the advantage of imposing a payment currency favorable to itself. Moreover, bilateral or multilateral agreements between the buyer and seller countries may stipulate or encourage the use of a particular currency. Finally, the parties often consider forecasts of currency value fluctuations to limit the risk of depreciation or to take advantage of potential appreciation of the chosen currency, thereby protecting their economic interests during contract execution. We need to choose a pricing method that suits the characteristics of the goods, the contract duration, and the level of market fluctuation in order to minimize risk and disputes. With a fixed price, the price is clearly determined at the time of contract signing and does not change throughout the contract term. This method provides certainty for both parties and makes it easier to calculate costs and profits, but it carries risk if market prices fluctuate significantly, especially disadvantaging the party exposed to price changes. With a price to be advised, deferred price, the parties do not set a specific price at the time of signing but agree on a method to determine it. For example, the price may be based on the FOB market price under Incoterms 2020 as published in a market price bulletin on the delivery date. This method is suitable for goods with highly volatile prices but requires transparent and mutually accepted price information. With a flexible price, the contract specifies an initial price while allowing adjustments if the market price changes beyond a certain threshold. For example, a unit price of USD 450 trên MTF OB Đà Nẵng Port Incoterms 2020 if the average market price in a week before delivery deviates more than 5% from the contract price will be adjusted to this average. With a sliding price, the price is based on a base price combined with an adjustment formula that reflects fluctuations in cost components such as raw materials and labor. In the formula, the new price is calculated from the base price multiplied by the total proportions of fixed costs, raw material costs, and labor costs, taking into account complex changes of each component relative to the contract signing date. This method is typically used for long-term contracts, industrial goods equipment, or projects where input costs vary significantly over time. Now we move to another important part of an international sales contract, payment terms. When drafting payment terms, the parties should clearly agree on three main issues. First, the payment currency. The contract must specify the currency in which payment will be made, such as US dollars, euros, or Vietnamese dong. The parties should also consider exchange rate risk, especially when the contract currency is different from the currencies used by the buyer and the seller. Second, the time and place of payment. The contract should clearly state when payment is due and where payment is considered to be made. For example, payment may be made in advance at the time of shipment upon delivery or after the buyer receives the goods. The place of payment may depend on the agreed payment method and the location of the bank involved or the method of payment. The parties need to specify how the payment will be made. Command methods include telegraphic transfer, open account, documentary collection, and documentary credit or letter of credit. Each method provides a different level of security, cost, and risk for the buyer and the seller. Therefore, when drafting the payment clause, these three elements should be stated clearly and consistently to avoid misunderstandings and payment disputes. In an international sales contract, The payment currency may be the same as or different from the pricing currency. Payment can be made in the currency of the exporting country, the importing country, or a third country. When the payment currency differs from the pricing currency, the contract must clearly specify how the exchange rate will be applied to avoid risk in the dispute. In cases where the two currencies are different, the parties need to agree on a conversion rate, which can be either a fixed rate stated in the contract or a rate determined at the time of payment. If the rate at the time of payment is applied, the contract should clarify which currency market is used, exporting country, importing country, or third country, whether the buying or selling rate is used, and which bank is the reference for payment. To minimize exchange rate risk, contracts often include foreign exchange conditions. One approach is to use the same currency for both pricing and payment while linking its value to a relatively stable reference currency. At the payment date, if the exchange rate changes, the contract price and total value are adjusted accordingly. For example, if the contract specifies the French franc FRF about the pricing and payment currency with a total value of 1 triệu FR F1 USD bằng 5 FRF, then if the rate changes to 1 USD bằng 6 FR, the total contract value will be adjusted to 1.2 triệu FRF. Another approach is to have the payment currency differ from the pricing currency, where the pricing currency is typically a stable currency. At the time of payment, the amount will be determined based on the exchange rate between the pricing currency and the payment currency. For example, if the contract uses USD as the pricing currency with a total value of 100,000 USD and payment is made in FRF at a rate of 1 USD bằng 5 FRF, the buyer must pay 500 FAF. Therefore, clearly specifying the payment currency and the method for determining the exchange rate not only protects the interests of the parties but also ensures transparency and enforceability of the contract under fluctuating exchange conditions. When specifying the payment terms in an international sale contract, the parties may agree on advance payment, side payment, or deferred payment. With advance payment, the buyer pays the full or partial contract value before delivery. This method essentially provides credit to the seller and can also be considered a deposit to secure the purchase. However, it increases the risk for the buyer. With that side payment is made before or at the time of delivery, usually upon presentation of a valid set of documents. This method helps balance the benefits and risk between the buyer and the seller. With deferred payment, the buyer is allowed to pay after a certain period, starting from the receipt of the shipping documents or the actual goods. This provides credit to the buyer, benefiting their cash flow, but increases the risk for the seller. In practice, contracts may apply mixed payment methods combining several forms, such as paying part in advance and the remainder as side or deferred, to balance the interests of both parties. Regardless of the method chosen, payments in international trade are usually made to commercial banks in accordance with the regulations of the respective countries. Now, let us look at the main methods of payment used in international trade. The first method is cash payment. Under this method, the buyer pays directly in cash. However, cash payment is not commonly used in international commercial transactions because of practical difficulties, security concerns, and legal restrictions. The second method is telegraphic transfer or Ch3. In this method, the buyer instructs their bank to transfer money electronically to the seller's bank account. Ch3 is fast and convenient, but the level of risk depends on the timing of payment. For example, if the buyer pays in advance, the buyer may face a higher risk. On the other hand, if payment is made after delivery, the seller may face a higher risk. The third method is open account. Under an open account arrangement, the seller delivers the goods first and the buyer makes payment at a later agreed date. This method is convenient for the buyer but involves a relatively high level of risk for the seller. Therefore, it is often used when the parties have a long-term and trustworthy business relationship. The fourth method is collection, also known as documentary collection. Under this method, banks act as intermediaries to handle the shipping documents and collect payment. However, banks do not guarantee payment. Therefore, the seller may still face the risk that the buyer refuses to pay or accept the documents. The fifth method is documentary credit, commonly known as a letter of credit or Ch3. Under this method, a bank provides a conditional undertaking to pay the seller, provided that the seller presents documents that comply with the terms and conditions of the Ch3. This method offers a higher level of security to both parties, but it is usually more complex and costly. Finally, we have cash against documents or CAD. Under this arrangement, the buyer receives the shipping documents only after making payment. Since the documents are often required to obtain the goods, this method provides some protection for the seller. In practice, the choice of payment method depends on several factors, including the level of trust between the parties, the value of the transaction, the bargaining power of the buyer and seller, the country risk, and the cost of the payment process. In the following sections, we will examine these payment methods in greater detail. Remittance is a payment method in which the payer requests the bank to transfer a specified amount of money to the seller, the beneficiary, through the banking system. The transfer can take place either before or after the seller delivers the goods, depending on the agreement in the contract. In this method, the bank acts only as an intermediary to transfer the funds and does not guarantee or ensure the delivery of goods or payment. The responsibility and risk primarily depend on the level of trust between the buyer and the seller. The basic procedure usually follows this sequence. The seller delivers the goods and chain or documents to the buyer. The buyer issues a transfer order at the bank. The bank transfers the funds into an intermediary bank or the seller's bank. Finally, the seller's bank credits the seller's account. Transfers can be made via telegraphic transfer (T through the STT through the FT system, which is fast and widely used in international trade, or via mail transfer (Merchant), which is slower and less commonly used today. This payment method is simple, low cost, and quick in terms of procedures, but it carries high risk for the party delivering goods if payment is made after delivery, and for the buyer if payment is made in advance. Therefore, it is usually applied when the parties have a trusted relationship, the contract value is not high, or it is combined with other security measures in an international sales contract. The open account method is a form of deferred payment in which the seller exporter opens an account to record the value of goods or services supplied to the buyer importer over a certain period. After delivering the goods, the seller does not demand immediate payment but a payment receivable in the buyer's account. The buyer is responsible for monitoring the recorded debt and, upon the due date, instructs the bank to transfer the funds to the seller. The buyer's bank transfers the payment to the seller's bank, which then credits the seller's account, completing the payment process. The open account method is simple, low cost, and convenient for payment, but it carries a risk for the seller because it largely depends on the buyer's creditworthiness and ability to pay. Therefore, this method is usually applied in long-term, trusted business relationships such as between parent and subsidiary companies or between established partners in the international market. A draft is a negotiable instrument issued by the drawer in which the drawee is required to pay an unconditional specified amount either on demand or at a specified future date to the payer designated on the draft. Drafts are an important tool for payment and credit in international trade. Payer drafts can be bearer drafts, where the holder of the draft has the right to receive payment, named drafts, which are payable only to the person named on the draft, and order drafts, which are payable to the order of the payee and can be transferred by endorsement. Based on maturity, drafts can be say drafts, which must be paid when presented, and term drafts, which are payable after a certain period from the date of issuance or acceptance. Based on accompanying documents, there are clean drafts, which are not accompanied by shipping documents and are usually used in clean collections, and documentary drafts, which are presented with a set of shipping documents. Typically used in documentary collections or under letters of credit. Based on negotiability, drafts can be named bearer or order drafts, with order drafts being the most freely transferable in the market. Finally, based on the issue, there are commercial drafts issued by the seller in a sale transaction, and bank drafts issued by banks, which generally offer higher reliability and security in international payments. This is the collection method in which the exporter, after delivering the goods, draws a draft on the buyer and entrusts a bank to collect the payment on their behalf. The bank acts only as an intermediary and does not guarantee payment, carrying out instructions solely according to the exporter at the action. The transfer of shipping documents to the importer may be conditional or unconditional depending on the type of collection applied. With a clean collection, the bank collects payment based only on the draft without accompanying shipping documents. The documents are sent directly by the seller to the buyer, which means the risk for the seller is relatively high. This method is usually applied when the parties have a trusted relationship. With a documentary collection, the draft is accompanied by the set of shipping documents, and the bank releases the documents to the importer only upon payment or acceptance of the draft under the agreed conditions. This method allows the seller to better control the receipt of goods by the buyer compared to a clean collection, but still does not provide any payment guarantee from the bank. In a collection, the goods and commercial documents are sent directly to the importer without passing through a bank. The bank only acts as an intermediary for collecting payment without controlling the goods or guaranteeing payment. Without controlling the goods or guaranteeing payment, the process works as follows. The exporter delivers the goods and documents to the importer while sending the draft to their bank. The exporter S-Bank forwards the draft to the importer S-Bank for collection. The importer then pays or accepts the draft to the bank, after which the funds are transferred back to the exporter S-Bank and finally credited to the exporter S account. Clean collection is only suitable when there is a high level of trust between the parties and the buyer has good credit and willingness to pay. The seller bears a high risk if the buyer fails to pay. This method is often used for settling old debt, internal company transactions, or sales between parent and subsidiary companies where the risk is controlled through long-term business relationships. The documentary collection is a payment method in which, after delivering the goods, the exporter prepares a set of shipping documents together with a draft and entrusts a bank to collect the payment from the importer. The bank releases the documents to the buyer only when the buyer fulfills the payment obligation or accepts the draft according to the agreed terms. In this method, the seller delivers the goods to the buyer under the contract, then prepares a collection package including the draft and shipping documents such as the bill of lading, commercial invoice, insurance certificate for origin, certificate of origin, etc., and sends this package to their bank. The exporter S-Bank forwards the documentary collection to the importer S-Bank to collect payment. The importer S-Bank notifies the buyer and only releases the shipping documents when the buyer meets the collection conditions, depending on the agreed form. Once payment is received or the draft is accepted, the importer S-Bank transfers the funds to the exporter S-Bank, which then credits the exporter S account. Documentary collections have two common forms: the chain pay documents against payment, where the buyer must pay immediately to receive the documents and collect the goods, and the chain R documents against acceptance, where the buyer accepts a time draft to pay later and receives the documents, with payment made on the due date stated on the draft. Compared to a clean collection, documentary collection better protects the seller's interest as the bank retains the shipping documents as control tool. However, it still carries the risk that the buyer may refuse payment or refuse to accept the draft, so this method is usually applied when the parties have an established and reasonably trusted business relationship. The documentary credit method is an arrangement in which a bank, at the request of the buyer, issues a letter of credit committing to pay the seller or any person designated by the seller upon presentation of all required documents and full compliance with the terms and conditions specified in the credit. This is a very popular payment method in international trade and is considered safe because payment does not depend directly on the buyer or seller but is guaranteed by the bank. There are four parties involved in this method. First, the importer, who is the buyer of the goods. Second, the exporter, who is the seller. Third, the issuing bank, which is the buyer S-Bank opens teller agency. Finally, the advising bank, which is the seller S-Bank that receives and advises teller agency to the exporter. The entire payment process follows UCP 600. the international rules for documentary credit. The payment process begins when the importer requests the issuing bank to open an emergency. The importer must submit an application and often provide collateral or financial guarantees as required by the bank. Once the issuing bank agrees to open tailored agency, it issues the letter of credit with specific terms such as the payment amount, validity period, type of goods, and required documents, then sends it to the advising bank in the exporter X country. Upon receiving tailored agency, the advising bank checks its form to ensure it is authentic, valid, and free of technical errors, then notifies the exporter of its contents. The exporter reviews the terms and, if acceptable, proceeds to deliver the goods according to the contract and the terms of tailored agency. After shipment, the exporter prepares a set of documents in accordance with tailored agency requirements, such as the commercial invoice, bill of lading, certificate of origin, and packing list. The set of documents is submitted to the advising bank, which forwards it to the issuing bank for payment. The issuing bank carefully examines the documents based on the terms of tailored agency and UCP600 rules. The bank does not inspect the actual goods, but verifies whether the documents comply. If the documents fully conform, the issuing bank is obliged to pay the exporter or pay to the advising bank. After payment, the issuing bank delivers the documents to the importer, who uses them to claim the goods from the carrier. Thus, the documentary credit process concludes when the seller receives payment and the buyer receives the goods, guide the documents. The most important point of tailored agency method is that the bank deals only on the basis of documents, not the actual goods. As long as the documents comply with the credit, the bank must pay even if there are issues with the goods. Conversely, if the goods are correct, the documents are incorrect, the exporter may not receive payment. When the parties agree to pay by letter of credit, say the payment clause in an international sales contract must be clearly and fully specified. Clearly defining these contents helps reduce risk, prevent disputes, and provides a solid basis for banks to make accurate payment. First is the type of letter of credit. The contract should specify whether tailored agency is irrevocable or revocable, confirmed or unconfirmed, and whether it requires immediate or deferred payment. In practice, the most common type today is an irrevocable agency, as it provides better protection for the exporter. Second is the beneficiary and the applicant of tailored agency. The beneficiary is the party to be paid, usually the exporter, while the applicant is the importer. Correct and consistent recording of names and addresses is crucial because even a small error can lead to refusal of payment. For this tailored agency amount and the currency of payment, the contract must clearly state the value of tailored agency, whether any tolerance is allowed, and the currency USD, EUSD, EUR, or other foreign currency payment amount and avoid exchange rate risk. Fourth is the issuing bank and the advising bank. The issuing bank is the importer bank responsible for payment when the documents comply with tailored agency terms. The bank notifies tailored agency to the exporter, usually located in the seller X country. Choosing reputable banks increases the security of the transaction. Next is the validity of tailored agency. The contract should specify the effective period of tailored agency, the shipment period, and the time allowed for presenting documents. If the period is too short, it may create difficulties for the exporter. If too long, it may increase risk for the importer. Finally, the set of documents to be presented for payment must be specified. The contract should list all required documents, such as commercial invoice, bill of lading, insurance documents, packing list, certificate of origin, etc. This is particularly important because the bank pays solely based on documents, not on the actual goods. Next, let us look at the payment method called cash against documents, or CAD. This is a payment method in which the bank acts only as an intermediary for collecting money and does not guarantee payment as in the letter of credit method. In CAD, the importer requests the bank to open a trust account. This account is used to pay the exporter when the exporter fulfills the delivery obligations or presents the required documents as agreed. Simply put, the importer deposits the money in advance with the bank, which only releases it to the exporter when the conditions are met. After agreeing on CAD, the exporter proceeds to deliver the goods. Once the delivery is complete, the exporter can get paid in one of two ways. The first is by presenting all required documents according to the prior agreement with the importer. The second is by delivering the goods to a bonded warehouse and obtaining a warehouse receipt signed by the importer as representative present at the warehouse. This receipt serves as proof that the goods have been delivered. After fulfilling the delivery obligations, the exporter submits the documents or warehouse receipt to the bank to request payment. The bank checks whether the documents meet the agreed requirements. If they do, the bank releases funds from the importer trust account to the exporter, the decoder. It is important to note that in CAD, the bank does not guarantee payment with its own credit. It only releases money that the importer has already deposited in the trust account. Therefore, the safety of CAD is lower than that of a letter of credit, but it is simpler, faster, and incurs lower bank costs. CAD is usually applied when the parties have a long-term, trusting relationship or when the contract value is not very high. The exporter still faces some risk if the importer delays or refuses to cooperate in confirming documents, while the importer has more assurance as payment is only made upon proof of delivery. In summary, CAD is the method based on the agreement and trust between the buyer and the seller, where the bank actually toward and release funds against documents rather than guarantee payment as in an emergency.